Hello, I'm Tag.
And this is Bob.
And you're listening to Bob and Tag Talk. Before we start the show, I'd like to point out that the topics discussed on Bob and Tag Talk are for informational purposes only. So please don't take this as investment advice. We urge you to do your own research before making any investment. So today we're going to be talking about personal credit products, which include loans, credit cards, and EMIs. So what do these personal credit products do?
So all these personal credit products are basically different for each individual. So every individual has their own credit score.
Right.
So for example, how much money can a bank loan you? What is the maximum limit?
Right.
That credit score is what CIBIL is calculating actually. So how much maximum loan can you take? And it depends on your income or your savings or however it is. What are the savings and what are the investments you have? And you use your score in such a way that how to keep a good score. That is most important thing.
Right.
So whatever the credit cards you take, whatever expenses you put on them, you need to pay the monthly amount regularly. Proper. You should not even miss any payments. And it is always a good practice not just pay the minimum amount, but more than the minimum amount or the full amount if possible.
Okay.
So most of the people who may be, let's say, well settled in life and all, they avoid using credit cards for various reasons. Credit cards are useful for people whose income levels are a little low. They have a lot of monthly expenses, and probably credit cards are a little bit useful to extend their expenses sometimes. So people who are just starting out to work or not joined yet and things like that.
All right. So all of these personal credit products basically allow you to get some money, some amount of money based on your credit score that the bank will provide for you.
Actually, banks don't actually calculate the credit score. So let's say you have a savings bank account, bank will give you a debit card immediately. And sometimes depending on your usage, how they'll actually see how much salary you're getting or how much money you're saving every month. What is the minimum balance that you're maintaining? And they'll have something called as a monthly account balance or quarterly account balance, and then so depending on that they may offer you a credit card. Every bank can offer a credit card. Now to offer a credit card, eventually they will, so for example, you may have multiple bank accounts.
Right.
You may have different types of loans and stuff like that. You can have a home loan, you can have a personal loan, or any different loans in different banks and all. So how will banks keep all the information about you? So they go to a agency called a credit agency. So this is CIBIL is one, and then you have a lot of other ones like a lot of other credit score agencies. So they will, using your PAN card, they will actually know what are all the different loans that you have, and they will actually calculate an amount called what's the maximum amount that they can eligible for.
Amount
what's eligible for?
Okay.
And then they'll basically turn it into a number called a credit score.
Okay.
Are you paying all the EMIs regularly? Are you paying off the loan regularly? If you have no loan, then you have an excellent score.
Okay.
So all these things are calculated, and then banks eventually will take that information and give you a product.
Right. Okay. Also, is there something like, let's say if you've got a loan already or something like that, is there will you still be eligible, say, for a credit card if you have like a home loan or some other type of loan?
So the thing is, there are different types of loans. Let's just categorize them. Most high amount loans are like home loans, mortgage loans, car loans or automobile loans, and then any large consumer loans you have. Those are all really high value. And there are low value loans like any like small consumer product loans. And then personal loans can be high as well, personal loans can be low as well. It depends on exactly what you're doing.
Okay. So my question is like, if you already have a loan, will it be a deterrent for you to get a credit card? Okay.
No, it will not be a deterrent to get a credit card. Credit cards are easy because credit cards are made easy because one of the main reasons is banks get a really good money out of you. It is very credit cards are very profitable for banks. So that is why it is not difficult to get a credit card. But it is difficult to get a proper loan. So when I say loan, I mean home, mortgage, car loan, consumer loan. When you go for loans, it is a little bit difficult because banks have to do a lot of processing and banks have to do a lot of documentation verification. If you default on your loan, that is if you don't pay your loan, the problem is with the banks. So they will take care of all the paperwork and make sure, think at least 10 times before giving you a loan. But credit cards, they don't think twice. Because at the end of the day, credit cards are like monthly use, and then eventually it will not bother you at much. But as you go longer and longer, the banks get so much more interest income out of you. So credit card is one of the ways where compound interest works against you. So let's say you spend 100 rupees, you have not paid it back. It becomes at the end of the next month, if you not paid it back, it becomes 120 rupees. The next month it becomes 140. And let's say you put 3 years or something, it will just, that 100 rupees will eventually turn into like skyrocket, 1000 rupees, probably even more than that. It is actually, it's for human beings, it is very, very difficult to think about compounding. So basically we can't think of a number that actually doubles every few days or every
just doubles,
few months.
Right?
So there's a very popular story. The story is a very actual good way of explaining compounding. There was a farmer and actually a king. The farmer was actually, I think, a farmer or a laborer, I'm not sure. So the king was very happy with his work. So he asked me, what gift would you like? So the farmer or the laborer, what he said is, give me a chessboard. So give me 1 grain of rice for the first square, for first month, or first week or something. And the second week you give 2 grains of rice, and the third day you give 3. So give 3 grains of rice for the third square, and so on. And then it's very small. I mean, are you sure you want this gift? And I said yes. And then fine, it's not a big deal. So the first stage is 1, 2, and 3. For a human being, it is very, very difficult. So 2 becomes 4, in the third. So it becomes 2 cube. And then it becomes 8 grains. And then it becomes 16 grains. Then becomes 32, 64. For the first 8 squares, it will not affect much. Next stage, it will not. But when you go to third and fourth, you calculate the number of grains, it's 2 to the power of 16, and then it's gigabytes. We actually know it's gigabytes, but the 1 grain of rice is 1 bit kind of. It's easy to understand for digital people. So, and it will be eventually sacks and sacks and sacks.
Sacks of rice.
Actually, I think the story is 1 sack of rice for 1 square egg. So in that way, it will become eventually. It will be so much.
Many,
it's an infinite number.
It's like a warehouse full of rice.
Not even that, it's infinite. It goes infinite, even at the third or fourth level itself. So the human beings are not wired to understand compounding. So that is why credit cards are very, very beneficial to banks.
Because the interest sort of like
the interest compounds in such a way that you can't even imagine.
Interesting. So yes, I get all of this. Coming back to the question that I had, I understand that credit cards are easy to secure. So what if there is a situation where you have a home loan and then you want, say,
another home loan or another
automobile, whatever it is, another big chunk.
Big ticket purchase.
Right.
So let's say you already have a home loan. Home loans are very, very different because home loans create an asset for you in an indirect way, not a direct way. So basically what you're doing is you're buying a home and the real estate value is always high, and the real estate is a real asset. It can always be sold. The value may decrease for a while, but the value is always inherent. That is the main, that's why it's called real asset. So the home loan is for a real asset. So when you take the home loan, first thing is you pay huge EMI. So the people who are giving you home loans always take care of they work the last 2 years of 3 years of statement, bank statement and all those things, credit scores and everything they will take into consideration, and they will decide the limit, 10 lakhs or 20 lakhs or and then first is the limit, then is the years, 20 years, 10 years or 30 years depending on your eligibility. There are different parameters that go into it. Now once you secure your home loan, it means you have decent score, you have the ability to repay the loan. The loan duration is 20-30 years. And usually first 10 years, let's say you have taken 10 lakhs, so you will be paying the interest for so many years. It's a 20-year loan. For 15 years, you'll be paying the interest. Only in the last 5 years, you'll be paying the actual terms of loan amount.
Okay.
But now the banking rules have changed, and they make sure that take the two parts: principal amount, the interest amount. Usually, interest amount is larger in the first 10, 12 years, and the principal amount is lower. What you're repaying to the bank. So the last few years only you're actually repaying the principal amount.
Right.
So when we repay a home loan, it's always we should repay the principal amount as much as we can, early as possible, so that the loan amount, let's say if you take a 20 lakh loan, the maximum amount you're paying should not be more than 35 lakhs back to the bank.
So
if let's say you take the home loan, to answer your question, so because it's a real asset, it doesn't matter, it does not affect your other loans. Because worst case scenario, if you're not able to pay your home loans, what the bank can do is they'll take care of your home. They will sell it and then they will get the money back.
Okay, that makes sense.
There may be some loss for them, but they have the main amount which is coming to them, because they take the home loan document is always with them until you complete the home loan. That's why it's a real asset. The same way goes with mortgage also. For mortgage and home loan, the difference is home loan, you take a home loan and then you buy a home. Mortgages, you already have a home and then you go to the bank, give the papers and say I want some amount. So I may be using it for some business, I may use it for some other personal, whatever thing is, health expenses, whatever it is, I want to take a loan on that. So whatever happens at the end of the day, the home or the farm or the land eventually goes back to the bank if you don't pay it. That's why they are okay
with
giving out 2 home loans if you are eligible. Eligibility criteria is very strict, so if you are eligible, you will get it. The thing with personal loans is, you may not be able to get multiple personal loans. Credit cards, you may be able to get multiple credit cards as long as your credit score is healthy. If your credit score is bad, then they will not issue credit cards also. So this is what credit score and then a combination of assets that you have is what affects you to get a loan or not. And there are some cases where, let's say, you have stock investments, you have bond investments, or you have insurance, ULIPs, unit-linked insurance policies, or insurance policies, insurance products with LIC and things like that. So based on, let's say, those products also, you can get a loan out of it. So
how do you get a loan out of that? What is the point or purpose of it?
So there are different types of insurance products. So one is called a pure insurance product. I don't know the exact term. It is like you pay 300-500 rupees. When you die, you get back the money. There are different kind of insurance where money back insurance policies. And then some other investment related insurance policies. So those policies are like you pay some amount every year. And then if you die, the insurance company will give you back the amount. Whatever you have paid, right? Let's say you're paying 10,000 every year. So at the end of 5 years, you would have paid 50,000. So you already paid 50,000 and that amount has compounded. So it may be worth 60,000 or 65,000. So they will make you eligible for a 65,000 loan amount. So you can take a loan from the insurance company itself or from a combinational bank, the bank who's actually collaborating with the insurance company and giving you a loan on it.
That's
so because you have already paid that money, and then they are giving you, because you're a trusted person who is already paying back a particular financial engagement regularly. That's why they're giving you a loan.
So, forgive me for the bluntness, but if you're dead, who gets the loan?
Your family. That's the whole point of insurance. Insurance is not for you. It's for your family. What happens after you?
So whoever you've nominated.
Your wife, kids, parents, siblings, can be anyone. Sometimes in business, people always also take insurance when they collaborate.
Or like business partners.
Insure the other partner. That happens also sometimes.
Wow.
Again, depends on the combination. Like sometimes you take insurance on homes, home insurance, fire insurance, different insurance. Anyway, those are all beyond the scope of what we are discussing today. And they are a whole thing to discuss probably on some other day.
Got it. So, coming back to the types of loans, we were discussing, you said home loans, you said mortgage loans. So, what are the other big chunk loans available?
You can see big chunk, meaning you can take industrial loans, farming loans and things like that. So it depends on what your occupation is.
What about for a individual? What
A
about
salaried individual? For a salaried individual, the big ticket one is usually automobiles.
Okay.
If not a home,
Okay.
then the automobile loan depends on the eligible amount. Some people can take automobile loan for 5 lakhs. Some people can take automobile loans for 5 crores.
Oh,
So it depends on your eligibility and your income.
Okay.
So on what type of car you're buying and
Right.
things like that, obviously.
Right.
So, and then probably obviously you can think of businesses, right? So transport businesses, generally they take loans to buy trucks.
Yeah.
Obviously it'll
need
be
it.
huge loans.
Yeah.
So it depends on what kind of automobile. For a personal salaried individual, it's always usually car. A car is usually a big deal. Again, the car interest rate also is generally, like, the interest rate is very, very important. So for a personal loan, usually the interest rate goes from, at least depending on the interest rate, it varies from 8% to 12%. For a personal loan. And if the interest rates are hiked by RBI or thing, sometimes it may go to 13, 15 also. I have seen times in the last 10, 15 years where it has gone to 15%, almost 13 to 15% of personal loan. Credit cards, if you will not believe it, credit cards will generally, when they advertise, they will say 2% interest. But the star asterisk is
Right,
that
that's a condition.
it's 2% per month. That will come to 24% per year.
Oh,
So
wow.
that is why it is very, very, very advantageous for banks.
Right.
It is not advantageous for you.
Okay.
And then home loans are generally 6 to 9%. It varies depending on what the amount RBI calculates. Sometimes it goes up to 10% as well. But generally, you should not get a home loan for more than 9 to 10%.
Right.
Because that's a big loan.
Yeah.
You want your interest rate as low as possible.
Yeah, because it gets compounded.
Yeah, that compounding will actually will hurt you.
Yeah.
And the banks always make sure that it does not hurt you this way. There are a lot of good regulations that have come in the recent years. Make sure that banks are very responsible. They're not overcharging customers. And then you can shift your home loans and things. A lot of things have come up now to protect that particular person who's taking the loan.
Okay.
Because it's a big ticket purchase.
Yeah. So consumer loans and personal loans can also be big ticket purchases.
It depends on what exactly you're using for. So for consumer loans, usually when you go to an Apple store, Reliance store or Chroma store or any Flipkart, Amazon, you can buy any product and you can just say, I want a loan from Bajaj Finance. I want a loan from ICICI.
Okay.
If you don't want to buy from a credit card.
Okay.
So there are different types of things. So now there are different types of solutions that banks offer and credit card companies offer. One thing is, first let's go to credit card. So what they will do is, let's say you are eligible for a credit card limit of 2 lakhs. So you want to buy a laptop, let's say for 50,000 rupees.
Okay.
So what they will say is, you take that particular laptop, you convert it into an equated monthly installment.
Okay.
You can pay it in 3 months, 6 months, 1 year. Very rarely, sometimes it goes to 2 years.
So basically, equated monthly installment, EMI is what we
EMIs. So you can take, depending on, you can buy the product on that. So what the actual credit card company is doing is, they tie up with the bank or they already had the funds. So they will create a kind of a loan for you. And then this is actually called, they'll turn it into a consumer loan.
Okay.
So it's not, they charge you on your credit card, but it's actually a loan that you're paying on your credit card. So as you pay your monthly bills, credit card bills, the loan will get automatically paid. So it is a linking of your credit card and your loan.
The actual loan.
So this is one way of doing it. The other is a proper consumer loan if you go to Bajaj Finance. Or if, let's say, even if you go to buy a bike or a scooter, right? You go to Bajaj, you want to buy a bike or a scooter from them. Bajaj Finance will offer you a loan for that immediately. You pay, let's say the bike is 50,000, a scooter is 50,000, you pay 5,000, the rest 45,000 you pay in EMIs. So this is a consumer loan or an not exactly an automobile loan, it's consumer loan. If you want an automobile loan, generally you go to a bank and get it.
Right.
So, but yeah, the terms can be used interchangeably depending on the companies.
Right.
Bajaj Finance may use consumer and automobile in a different way because
it's still a loan.
It's still a loan. At the end of the day, it's still a loan.
What about buy now, pay later?
That's one of the new things that are coming up. Actually, buy now, pay later in US and Europe when it was introduced. So it was introduced for luxury products.
Okay.
So for example, actually it's rich people who buy, they will always pay in cash. They don't use credit cards and stuff like that. That is not rich. I'm not talking about rich people. I'm talking about wealthy people.
Okay.
People who are wealthy don't use credit cards.
Okay.
People who are not wealthy, who cannot afford it. So what they do, they want a luxury product. They take the luxury product and they pay later.
Right. Just to clarify, when you say wealthy, Wealthy is one cut above rich.
Yeah, rich is completely different.
Okay.
Wealthy is like you don't need banks. You don't go to them. They come to you. That is wealthy.
Okay, understood.
You don't go out of your house for anything. They come to your house for everything. That is the meaning of wealthy.
Okay, understood. Continue.
So rich means like you have a lot of income and you can afford to spend some things.
Okay.
Or sometimes you don't even have income, but you pay, you consume, and then you're rich. So it's a different.
I just wanted to know where you categorize both of them, what tier it falls on.
Yeah.
You were talking about why rich people...
BNP later, yeah. BNPL, buy now pay later. That's how Europe and they actually it came for luxury goods. Common people cannot afford luxury goods. So eventually the number of people generally who buy luxury products, they want to expand the scope. So how do you get people hooked on to buy luxury products? So they introduced BNPL. We already had the EMI concept. BNPL is not very different. Okay. It is just that instead of paying a monthly EMI, let's say for 6 months you don't need to pay anything, or for 1 year you don't need to pay anything. You can pay after 1 year.
Oh.
You completely postpone the amount. For 1 year you just use it or something, whatever.
And then after that 1 year you pay the full amount.
Either you pay the full amount or then your EMI starts.
Oh.
Just pay later. You don't worry about paying when you want to pay.
Right. And that later you sort of like cash out in the conditions.
Exactly.
Like after your 6 months and start paying.
It depends on the company that is offering the BNPL scheme.
Okay.
Say Flipkart offers it, they may say 6 months, after 6 months or after 3 months you pay it and things like that. So that's also a little bit dangerous because the interest rate, the charging by those companies, you never know. It is not pre-announced.
Oh, so you only get to know the interest rates once you start paying your...
Not necessarily. Ideally, it's all hidden in a lot of things. So, for example, they may say that you may pay a normal interest rate of 5%.
Okay.
What are the hidden charges? What are the service charges?
Right.
Those are all not properly defined. So, those are the risks. Some companies maybe do it really well. Maybe some good companies are doing it. But you never know who is actually offering the BNPL scheme.
Right. Yeah. So, there's obviously a lot of like scams for
personal
and
loans, things like that.
Yeah.
And there are also new things like digital loans. So these digital loans are basically you have an app, you download that app, you enter your PAN card and other information. Immediately you ask for 5 lakhs, they will give you 5 lakhs in your...
Yeah, that's like pre-approved loans or something like that.
See, pre-approved by banks is one thing.
Okay.
Because you have a banking account, they know who you are and everything. Okay. That's a different thing. You have pre-approved home loans, you have pre-approved personal loans, you have pre-approved automobile car loans. Because they know that you are able to pay it back.
Right. So with
these new apps and things, see, they just have funding. They have a lot of money. They want to earn interest money. So they just give out these loans for anyone. They don't check your credit history. They don't check anything.
But they should, no? If they don't, that's a scam, right?
Not necessarily. See, they should in the sense as long as you are paying, they don't worry about it. Only when you're not paying, they'll start calling you and harassing you.
But that is a financier, no? It's not exactly... how do I define it? So it's not like an app where you give out loans to people. But even in those sort of situations, they check your credit score and then
they are duty bound to check it. But for example, there's a private company.
Right.
They're starting a digital loan scheme.
Right.
They don't need. They'll take your PAN card. They may know that you may not be able to pay it off. But sometimes they really want you not to pay it off. Because only then the interest charges will increase.
Okay.
And then if you're not able to pay it off, a lawyer would call you and threaten you that they will put a consumer court case or whatever case on you if you don't pay it off and so on.
Right.
That is a legal kind of thing. Right. But some shady companies, as you said, financiers, who do this kind of digital thing, and then they actually harass you or threaten you and things like that. People have really gone, they get stuck with these high interest rates.
Yes.
And then, so that's why it's a very dangerous thing, and you have to really know what you're getting into.
I guess you can't really call them as scams, but they're very close to scams. Because
they are scams because they are not scams are something that you take money from you.
It's like you don't know that it's
happening. It's a scheme where they are charging exorbitant amount of interest.
Okay.
The interest rates are very high. Okay. Credit cards are charging 20%. They may charge even more.
Okay.
So that is the problem.
Okay, understood.
Because when you know you cannot pay it,
right,
and they suddenly, because you cannot pay it, they'll add an extra 10% surcharge.
Oh.
When you know you can't pay it, how can you apply an extra 10% surcharge?
Okay.
So that's the problem that comes in all these things. Where is the maximum limit? So, for example, with these banks and all, let's say you're not able to pay back all your loans, what can you do?
I don't know, offer some collateral? I don't know.
If you don't have collateral, what do you do?
Go into debt.
You have to go to the government, you have to go to the courts and declare bankruptcy.
Okay.
So there is a process, there is a bankruptcy process, there's a legal process, where on some business scenarios and all, people will declare themselves as bankrupt, they'll close down the shop and everything. When you're personal, when it's everything personal, there is no bankruptcy. So there is no bankruptcy thing as like in the business way there is. So when you're personal, even if you die sometimes, your son or your daughter needs to pay back the loan. It even happens with home loans. So home loans also, there is a big risk with home loans.
Right.
Generally, when you go to SBI or some really good banking companies, what they will suggest you is when you take a loan, they will not force you. They'll suggest you to take an insurance on your loan.
Okay.
Which is very important. If you die, your insurance policy is equivalent to your home loan property. So the insurance company will pay to the bank, and the home still belongs to your family, even if you die.
Okay, I understand.
Some banks don't do that. So if you take a home loan, you take a really large home loan, you're not taking insurance with it. Let's say something happens to you.
So the bank will be able to take
away the home. So what happens to the family is where the problem comes. So there are some responsible ways of banking, and there are some irresponsible ways or really careless ways of banking and doing things. So this is where banking really gets a bad name. So people who do it well, do it nice, and they protect the consumer. So people who do it badly, then that's when all these people have trust in banks are very, very low.
Yes.
Trust in people in banks is very low.
I suppose then that the same would apply to a digital loan sort of scheme.
Digital loan, see, you can take a digital loan from HDFC, HSBC, Citibank.
Okay, so what if it's like a more private company? That's also the same sort of risk. Okay.
The risk is completely different. So as long as they come under the ambit of RBI, so RBI has a consumer protection group, consumer protection clause. They are not allowed to harass you. People are not allowed to come into your home, bang into your door and ask for money.
Right.
Or threaten you.
Right.
So those kind of things banks are not allowed to do. But these private companies are allowed to do.
Okay. No, I understand.
I knew of a recent story that I read in the internet that a lady who had actually by mistake taken out a digital loan and then for some reason, because of COVID or something, she could not pay it back or something. And people would come into her house and then they'll not even let her go to work and things like that. So these are all very dangerous situations. You should not ever get involved in it.
We don't mean to scare all of you all, but we just
you
want
read the terms and conditions and know exactly whom you're getting the loan from.
Yes.
Sometimes that's one more thing, like Amazon and Flipkart, they give BNPL loans also. So what they do is, they will immediately block an amount. Okay. So, for example, let's say companies like Ola, there's a thing called Ola Pay Later or something like that. Yes. Or Uber Pay Later or something like that. A lot of all these companies have it. So, let's say 2,000 rupees, right? Let's say that is a charge or something for Ola, Uber, or 5,000 rupees or 10,000 rupees for Amazon. They block this amount from your credit card or from your credit score. They will register that. You will not know that that amount is blocked. So if your total eligibility of credit is 5 lakhs, so when you actually opt for it, you're not taken the money yet.
Right.
You just say that, okay, I have the option of using this for, let's say I'll travel and then I'll pay it later.
Okay.
So what these companies do, they'll block that 5,000 rupees or 10,000 rupees from your eligible credit score.
Oh. Okay.
Even though you're not using it.
Oh.
So that's the one way of how people. So the loans, it's automatically in the background, like the loan is automatically approved for 10,000, but you have not taken it yet. Okay. This is how some of the BNPL schemes, even from established companies, work, and it is legal to do it. Right. That is a big problem. So people are trying to change these ways, and that's why people are suggesting to go and check your credit score every 3 months, or at least 3 months, or if possible, you will do it every month.
Okay, I have 2 questions. One, so you said that they block a portion of the credit score.
So let's say, I can explain to you an example.
Yeah, okay.
Let's say you went to some popular shopping site.
Fine.
And they have a scheme of up to 10,000 rupees. You can choose for this BNPL. And then when you buy it, you don't have to pay the money. You will get the product first and then you can pay it later.
Fine.
after 3 months or something.
Fine.
So how it actually works is, let's say you brought up a laptop, let's say,
Okay.
for 50,000 rupees.
Okay.
Let's say you are they approved it for BNPL. So your eligible credit score, let's say, is 1 lakh. That is you are just starting out your career. You have let's say 2.5 lakh some salary.
Fine.
So 1 lakh is your eligible credit.
Fine.
Legal credit, eligible legal credit.
Okay.
So 50,000, what they will do, they'll block it.
Fine.
So now let's say you want to take out a personal loan. So the personal loan people will check that and see that Amazon or
Has already
Flipkart or
blocked.
any other shopping site, they already blocked that amount.
Right.
So their personal loan limit, you can't take 1 lakh. Even though your credit score is 1 lakh, even though you have not, if you have brought the product, fine, you pay it off and then you take the personal loan.
Okay.
That is one. But if you are not, sometimes some shopping sites do it in such a way that even though you have not brought a product, and then they have blocked that amount, but when you go for apply for a personal loan, it is still half.
Okay.
So you have to go and explicitly contact the company, ask them to release that particular block.
Okay. My second question is also slightly related to that. I got the answer for my first question. So you said that it gets approved, but you don't use it, but it's still there.
It's ready to use, but
It's
you have
ready
not
to
used
use.
it yet.
So what happens to the interest rates?
There is no interest. Thankfully,
Okay.
there are no interest
Okay.
rates.
That's what I wanted to know.
At least now, I have not heard of any instances that are charging interest for amount that is not used.
Okay.
It's just a way of simplifying credit.
Right.
So, but it works in different ways. That's
So what are the problems with this? Because if there's no interest rates, it's just that blocking thing is a
problems.
problem.
Yeah,
the
it
credit score
affects your credit score.
problem. Okay.
It affects
Understood.
your credit score. Let's say you're going for a home loan and you see that something that is blocked. Obviously, the amount eligible for home loan is less.
Okay. I understand. So we spoke a lot about personal.
Yeah, there are a
credit
lot of
cards.
risks. There are a lot of things that's why there are some times where you should read terms and conditions.
Yes, I definitely agree.
At least financial things.
Yeah, especially when you're taking out a loan, make sure it's from, even if you're taking it from like a private.
Reputable. Make sure it is reputable company.
Yeah. Make sure they usually like check your credit score, and then they don't like ask for additional fees or whatever it is.
And there's no problem in asking, what if I don't pay it off?
Right. Yeah.
But we have not discussed one simple part of it: personal loans, right? Why do you take personal loans, and why would companies give you personal loans?
I think it's for. I know that there are certain people who take personal loans for like a situation like a marriage.
Yes, exactly right. Personal loans can be used for marriages, buying some consumer products, for buying anything, and then it can be used for buying automobiles as well.
So what is the difference then between consumer loans and personal loans?
Consumer loans are generally called consumer loans because anything that a consumer buys, they call consumer loans.
Okay.
Personal loans, so all consumer products can also be considered personal loans, but it can also be used for paying your hospital expenses, for some emergency surgeries, for emergency things. So all these emergencies, that's why personal loan is there. It's supposed to be used for emergencies only.
Okay.
But this consumer loans eventually got merged with that, and then that's why there's a lot of confusion.
Okay, understood. Okay. So yeah. So we talked about home loans, mortgage loans, automobile loans, big ticket loans, and then consumer loans and personal loans can be big ticket loans or not, depending on your.
So marriage is a big ticket item.
Yeah.
So sometimes you can take 10 lakhs for your marriage or things like that. And there's one very, very important caveat. Whenever you are asking for a personal loan, they'll actually generally ask you, what are you using it for? Always be truthful in that way, because some people have got stuck with problems and issues because some people lie and say that I'm going to use it for something, and then they eventually invest in the stock market and they lose the money and so on. So you should never use personal loans to use for stock market or any other.
Yeah, it doesn't really make sense. Why would you go into a debt to make an investment?
Basically, it's for traders. Traders are generally, there are some good traders and bad traders. So generally there are some bad traders who take whatever kind of loans and they try to trade and make more money. So,
Okay. Yeah, something to keep in mind. So yeah, home loans, mortgage loans, automobile loans, consumer loans, personal loans, and then something called BNPL. We also saw digital loans. how they work, and what are the risks associated with it,
Yeah.
what you should be careful of when buying a loan. And yeah, we also saw very importantly about the compound effect of
Compounding is very, very important. Like I said, the interest rate compounds. So it's very important to understand that it works against you.
When it comes to loans and other
Yes.
debts, it obviously works against you. So if you can pay your loans off quicker, it's much better.
The one simple thing that everyone can do is go to the website, any website, see that, let's say, there are a lot of tools to check. Let's say you take 50,000 rupees or 10,000 rupees loan and a credit card. Just take credit card as an example. You have credit card payment for 10,000. You're only paying the minimum amount every month.
Right.
Let's say minimum amount is always lesser, like 500 rupees.
Okay.
You pay 500 rupees every month. How long does it take you to complete that 30-year loan? How much time it takes to give it back?
Okay.
So if you take the time, then you will understand how compounding works against you.
Got it. So yeah, that's been personal credit products, and I think that's a good spot to end it there today. Hey, thanks for listening to Bob and Tag Talk. Please consider following us on our Instagram and Facebook pages. We put out weekly summaries of the topics discussed on the podcast. And if you found this episode informative, please like, share, and subscribe.